Did you know that the average American household carries $96,371 in debt? That's everything from credit cards to student loans, mortgages, and car payments. But here's the kicker: 75% of people are struggling just to make the minimum payments. No wonder it feels like debt never goes away. You've probably heard the usual advice: cut your spending, pay more than the minimum, repeat. But what if I told you there's a smarter way? A way that not only helps you pay off debt faster but also grows your wealth at the same time. In this video, we'll explore strategies that go beyond the basics. You'll learn how to manage your cash flow like a value investor, use market opportunities to time your debt payments, and even invest while paying off debt safely. Stick around, because by the end of this, you won't just be debt-free, you'll have a plan to build wealth, too. Ready to change the game? Let's dive in. Chapter 1. The Debt Trap. Why paying down fast isn't enough. We all know debt can feel like quicksand. The more you struggle, the deeper you sink. But here's a twist most people don't realize: paying off debt fast isn't always the best move. Sure, it feels good to knock out a loan early, but what about the opportunity cost? That's a term value investors use to describe the loss of potential gain from other opportunities while focusing on one task. So, if you're throwing every spare penny at debt, you could be missing out on higher returns elsewhere. Consider this: the average stock market return over the last century has been around 7–10% annually. If your debt has an interest rate below that, say 4%, you're potentially losing money by focusing only on paying off debt. Investing that extra cash could lead to better financial outcomes in the long run. Warren Buffett once said, "The best investment you can make is in yourself." Sometimes that means holding onto good debt, like a mortgage with a low rate, and investing the money you'd use to pay it off early. It's not about drowning in debt forever, it's about using your resources strategically. Focus on high-interest debt first, credit cards or personal loans with rates above 15%. Knock those out as fast as possible. Then, when you get to lower interest debts, consider whether your money could work harder for you in investments. Chapter 2. Debt Snowball versus Debt Avalanche. The hidden winner now. Let's talk strategy. You've probably heard of the debt snowball and avalanche methods, right? The snowball focuses on paying off your smallest debts first, while the avalanche tackles the highest interest rate debts first. Here's an interesting fact. According to a 2016 study by the Harvard Business Review, people who used the snowball method were more likely to stick to their plan and pay off all their debts. Why? It taps into psychology. The sense of accomplishment from crossing smaller debts off your list gives you the motivation to keep going. But mathematically, the avalanche method is the most efficient. You pay less in interest over time because you're attacking the debt that costs you the most. So, which is better? The answer lies somewhere in between. Value investors know it's not just about numbers, it's about emotions too. Start with the snowball approach to build momentum, then switch to the avalanche method as you gain confidence. This hybrid strategy gives you the best of both worlds: emotional wins early on, followed by long-term savings on interest. Pro tip: write down your debt payoffs like they're investment goals. Create milestones for each debt, just like value investors track stock purchases and gains. Chapter 3. Invest to pay debt. A radical, but safe, twist. Now here's where things get a little unconventional but super effective. Most people think you should focus entirely on debt repayment before investing. But what if you could do both at the same time, and do it safely? Here's how. Take a small portion of your budget, say 5–10%, and set it aside for investing in high-return opportunities. We're not talking risky stocks or speculative plays here. Think of value investments, solid companies trading below their intrinsic value. These kinds of investments historically provide steady returns, even during uncertain times. Let's say you're paying off a $20,000 debt with a 5% interest rate. You could put 10% of your extra cash into value stocks, which, on average, have returned around 7–9% annually. While your debt is slowly getting smaller, your investment is working for you in the background. Over time, those returns can help you wipe out larger debts faster than you could on your own. It's important to understand that this isn't about putting all your eggs in the investment basket. It's about balance. By combining debt repayment with smart investing, you're not only reducing your liabilities, you're growing your wealth at the same time. Charlie Munger, Warren Buffett's right-hand man, once said, "The big money is not in the buying or selling, but in the waiting." So, while you're tackling debt, let those investments grow. In the long term, they could make a bigger dent in your overall financial picture than you think. Before we move on, hit subscribe and let's dive back into more great content. Chapter 4. Cash Flow Mastery. Turning debt into a wealth opportunity. One of the biggest keys to paying off debt quickly, and staying out of it, is mastering your cash flow. It's not about how much money you make but how you manage what's coming in and going out. Here's a surprising fact. According to a study by the Brookings Institution, nearly 40% of Americans struggle to cover a $400 emergency expense. That's a cash flow problem. When debt payments eat up too much of your monthly income, it feels like you're constantly playing catch-up. So how do you fix it? Think of yourself like a value investor running a lean company. Every dollar is an employee, and each one needs to work for you. Start by breaking your budget into 3 categories: essentials, debt repayment, and investments. Essentials are the non-negotiables: rent, food, utilities. Next, make sure you're making meaningful debt payments. Finally, allocate a portion, even if it's small, to investments. This is the value investor's budget. It's not about cutting out every luxury. After all, even Warren Buffett enjoys a good cheeseburger. It's about optimizing your cash flow so that your money grows even as you pay off debt. One trick to improve cash flow? Automate everything. Set up automatic payments for debt and investments so you never miss a payment or forget to invest. It eliminates decision fatigue and makes sure your money is working hard without needing constant attention. Chapter 5. The Buy Low, Pay Low Strategy. Timing debt payments. Like a value investor, we've all heard the advice to buy low and sell high when it comes to investing. But did you know this strategy can also apply to paying off debt? Timing is everything. Let's say you get a tax refund or an unexpected bonus at work. Most people would throw all that cash at their debt, and while that might seem smart, it's not always the best move. If there's a major market opportunity, like stocks at a deep discount, you could invest that money instead of using it for debt repayment. Why? Because the returns could far outpace the interest rate on your debt. This is especially true with lower interest debts, like a mortgage or student loans, which often have interest rates under 5%. If you can get a return of 7% or more in the market, you're essentially paying off your debt with money your investments earn. On the other hand, if the market's not looking great, or if you feel uncomfortable with risk, that's when you go all in on debt repayment. Pay low-interest debts more aggressively when there's no clear investment opportunity, then shift back to investing when the market offers better returns. Ben Graham, the father of value investing, said, "The essence of investment management is the management of risks, not the management of returns. It's about balancing your risk with reward." In this case, timing your debt payments with market conditions lets you get the best of both worlds. Chapter 6. Debt-free but not done. Building a financial fortress. Once you've paid off your debt, what's next? Most people breathe a sigh of relief and stop there. But the truth is, the journey doesn't end once the debt is gone. You're just getting started. Debt freedom is the foundation. Now it's time to build your financial fortress. The key is to shift your focus from paying down liabilities to building assets that work for you. The first step? Create an emergency fund. Even though you're debt-free, unexpected expenses can crop up at any time, and you don't want to fall back into debt just because of a car repair or medical bill. Studies show that households with an emergency fund are significantly less likely to take on high-interest debt. In fact, according to the Federal Reserve, 40% of Americans who don't have an emergency fund rely on credit cards for emergencies. Don't let that be you. Once your emergency fund is in place, it's time to ramp up your investments. If you've been putting a small percentage of your income into investments while paying off debt, now's the time to go full throttle. Think of it like compounding. Small efforts grow exponentially over time. Warren Buffett often credits compounding as the most powerful force in his wealth-building strategy. And don't forget about diversifying your investments. Stocks are great, but you can also look at real estate, bonds, or even starting your own business. The key is to have multiple streams of income, so you're never reliant on one thing. Debt freedom isn't the endgame, it's the launchpad for financial independence. And with the strategies you've learned through value investing, you'll be well on your way to not just surviving without debt, but thriving. Hit subscribe to support our channel and be the first to see new videos.